What if I told you that China's real debt problem isn't just big, it's massive? In fact, it's estimated to be over 300% larger than America's. And what's even more shocking, hardly anyone outside China truly understands how deep the problem runs. When people think of global debt, they usually imagine the US government's $35 trillion deficit or Japan's long-standing borrowing. But quietly, beneath the surface, China has built one of the largest debt bubbles in human history, one that's now threatening to shake the global economy. Today, we're unpacking how China got here, why its debt is so complex, and what could happen next. Because to understand the future of the world economy, you need to understand what's happening inside China's financial system. The beginning. China's growth model after 2008. To understand China's debt story, we need to rewind to 2008, the year the world economy collapsed after the US financial crisis. While the West was bailing out banks and cutting spending, China went in the opposite direction. Beijing launched one of the largest stimulus programs in history, roughly $586 billion, to keep growth alive. The idea was simple. If the world stops buying Chinese exports, China will build for itself. New cities, railways, airports, bridges, entire industrial zones were built almost overnight. It worked for a while. China's GDP skyrocketed. Tens of millions were lifted from poverty, and the country became the world's manufacturing powerhouse. But there was a catch. All that building wasn't paid for by productivity or innovation. It was paid for by debt. Local governments borrowed heavily, banks lent aggressively, and state-owned companies expanded recklessly. By 2015, the Chinese economy was addicted to debt-fueled growth, a system that worked only as long as everyone kept borrowing. The local government debt machine. Most people assume China's debt means the national government's borrowing, but that's not the real problem. The real issue lies in local government financing vehicles LGFVs, shadowy entities created by regional governments to fund massive construction projects. These LGFVs borrowed trillions of yuan to build roads, stadiums, housing complexes, and infrastructure that often produced little to no return. Think of them as local mini-governments running on credit. They borrowed from state banks, issued bonds, and rolled over their debts every few years, keeping the illusion of progress alive. But now, more than $12 trillion in local debt is estimated to be hidden across these vehicles. And many of these projects, ghost cities, empty malls, underused airports, generate no real income to repay the loans. So, local governments began doing what most over-leveraged borrowers do. They borrowed more to pay old debts. It became a cycle. New debt to hide old debt. The real estate explosion and collapse. If the local governments were the engine of debt, the real estate sector was the fuel. For years, property became China's favorite investment. Apartments weren't just homes. They were a savings account, a status symbol, and a speculative asset. Developers like Evergrande, Country Garden, and others borrowed billions to build entire cities of luxury apartments. People rushed to buy, often taking multiple mortgages, believing prices would never fall. At its peak, real estate contributed over 25% of China's GDP. That's higher than any major economy in the world. But then came the reckoning. In 2020, Beijing launched its 3 red lines policy, rules limiting how much property developers could borrow. The idea was to cool down the overheated market. Instead, it triggered a meltdown. Developers couldn't refinance. Projects stopped. Home buyers refused to pay for unfinished apartments. And suddenly, the world saw China's property bubble burst, with Evergrande's $300 billion collapse symbolizing the end of an era. Comparing to America, the dollar advantage. Now you might ask, Wait, doesn't the US owe trillions too? So why isn't America collapsing? That's the key difference. The US borrows in its own currency, the US dollar, which also happens to be the global reserve currency. America can print dollars to manage its debt, and global investors keep buying US bonds because they trust the system. China, on the other hand, borrows mostly in yuan. Under a closed financial system, it can't export its debt to the world. The burden stays inside the country. Even worse, a huge portion of Chinese debt sits on the balance sheets of state banks, meaning if things go bad, the government itself must step in. That's why China can't just print its way out without risking currency collapse or capital flight. So while the US faces visible debt, China faces hidden, internal debt, harder to measure, harder to control, and far more explosive. The ripple effects. Why it matters to you. Now you might think, okay, but how does China's debt crisis affect me? The short answer, it already does. When China slows down, the entire world feels it. From African mines to European car makers, China's demand drives global trade. If its local governments cut spending, global commodity prices drop. If its companies default, Asian financial markets shake. And if its property sector collapses further, millions of middle-class Chinese lose wealth, which means less consumption, less imports, and slower global growth. For emerging markets that depend on Chinese investment, like much of Africa and Southeast Asia, that means fewer infrastructure deals and slower development. And for the West, lower inflation in the short term, but higher instability in the long term. Because a weakened China doesn't just mean less trade, it means more financial risk across global supply chains and currency markets. The deeper lesson: debt, growth, and illusion. At its core, China's crisis isn't just about bad loans or property bubbles, it's about the illusion of endless growth. For decades, the world believed that China could grow forever, that building cities, factories, and railways would always lead to prosperity. But real wealth doesn't come from pouring concrete. It comes from productivity, innovation, and sustainable demand. China's debt story is a warning to every nation, including America. When growth becomes dependent on borrowing, the economy stops serving people and starts serving the illusion of progress. So, what happens next? China will likely continue to manage its debt quietly, restructuring, rolling over, and hiding the cracks. The collapse might not come suddenly, but slowly, like air leaking from a balloon. But the consequences are already here. Slower growth, weaker consumption, and a government walking a financial tightrope. We've just explored how China's debt grew silently into a monster, one 300% bigger than America's. It's a story about power, ambition, and the price of chasing endless growth. If this video helped you see the bigger picture, leave a like, subscribe, and turn on the notification bell so you never miss an episode. And drop a comment below. Do you think China can manage its debt, or is a global reckoning coming? This is The Economic Mind, where we bring clarity to chaos.